Hey, welcome to another episode of Breakaway from the Rat Race. And today I have the pleasure of speaking with Matt Simmons. Matt Simmons has 20-year business veteran, 16-year experience in real estate and investing. He has over $250 million under management and $470 million in total transactions since 2014. Matt has always been seen as a forward-thinking businessman. SIMM Capital, the company that he's part of, is one of the fastest growing privately held real estate investment companies with a focus on multifamily, but now also on affordable housing in the country. And we're going to talk about a lot about affordable housing, Section 8, and what's coming up in the economy with Matt. Matt, welcome to the show.
Thank you for having me on. I'm excited to be here.
Yeah, so tell me a little bit more about kind of like SIMM Capital, what you do there, and also kind of like, I know you do a lot of multifamily, and that's been kind of like a core of SIMM Capital, and now I think there's been a little bit more of a balance with affordable housing.
Yeah, so SIMM Capital, we are basically, I guess you could use the hot term right now, or that's been going on in the last few years, is we're considered what they call a syndication group, right, or a syndicator. But basically, we're a private equity real estate investment firm. We raise money from private investors, retail investors, high net worth individuals, as well as some institutional capital. And up to about a year or so ago, our primary focus has been Class B, Class C multifamily, primarily across the Sun Belt and the Midwest areas of the United States. However, with the pandemic, the slowdown, the rent moratoriums that were put into place, leaving us operators kind of holding the bag for everyone, I specifically was looking for a little bit of a risk hedge against that ever happening again. We know if the government gets away with it once, they're going to do it again at some point, or try to anyhow. And so what we looked into is where can we find a little bit of a risk hedge to guarantee that we would get paid rent on a monthly basis. And really the only asset class that there is that does that is the affordable housing Section 8 asset class. Mm-hmm. Now, I have experience with that going all the way back to 2006 when I started acquiring just my own personal properties. And so for me, it felt like a great, just a great offering, an additional asset class to add to the company, to be able to provide investors with a little bit more of a stable type of investment versus the multifamily that, again, we saw was dependent somewhat on what the government was doing, especially during that pandemic shutdown.
Yeah, I know for me, like I started in the single family rental space, and then I moved into the multifamily because I was able to get more value adds.
More bang for your buck.
So it was great for that perspective, and you kind of capped when you do single family rentals or these kind of flips, you're capped at the comps. So with apartment buildings, you don't have that cap. As long as you get the rent, if you get the net operating income very high, and then it's in great shape, you're going to get great value for your building. And then, I mean, so we had five buildings at one point, and then we sold a bunch, and now we're kind of like all the way back to single family rentals. We can't affordable, like in terms of acquisition, multifamily buildings anymore. So what's going on?
Well, you're absolutely right, and I think a lot of that is just kind of the result of the market over the last 3 to 5 years, especially with the extremely low interest rates. I mean, if you're looking to buy, for us, we were looking to buy multifamily properties. If we went agency debt on those, we were in the 3% interest rate range on larger agency debt type of loan products. Mm-hmm. And so what you had this giant influx of new operators that saw the opportunity, that saw the growth in multifamily, and saw the opportunity to be able to get a really low interest rate and come in and acquire properties at that low interest rate that would cash flow. And so you had a bunch more competition, a bunch more people coming into the market. They saw the other syndicators or the people that have been around a little bit longer being successful with it. They saw the opportunity. That just drove the valuation of these properties high. And up, along with the fact that you saw, a fairly strong economy up till about 2020, 2021, where wages were on an increase, unemployment was extremely low, and so you had a lot more growth and rental growth as well. And when there's rent growth, that just increases the valuation of the property because your NOI is going to go up, right? Which means your cap rates are looking good, and so your valuations were high. So you could buy a property, a multifamily, at a 4% cap or 4.5% compressed cap rate because you're getting 3% interest rates, right?
Yeah.
So that to me is what is the biggest driver of why you saw these properties prices really just go through the roof to a point that was really unsustainable and unsellable now, right? Because you have these
exactly
you have these sellers now we're in interest rate range between if you go agency debt, you're still 5.5% to 6% maybe, but if you do bridge, you're 7% to 10%, right?
Yeah.
And now these people that went in, and if they did a bridge loan to purchase those properties, figuring that they were going to add the value and then refinance out of them, now they're finding they can't cash flow on their refi because their interest rate's double than what it was.
Yep.
So, but you have these sellers that are still wanting, anyone that's looking to sell their property in their multifamily right now, they still think it's 18 months ago, and they're trying to sell at a 4.5% cap rate, even a 5% compressed cap rate, but the property doesn't cash flow and it's not profitable because of where interest rates are. So you're starting to see, so for the past, I'm going to say 12 months, you had a lot of unrealistic sellers. That we're trying to get top dollar, but there was no way that they could. I see that starting to shift. And I see what I think is going to happen, and this is what I keep telling everyone, is up until, I don't know, well, really up until now, you're dealing with sellers that want to sell their multifamily, right? We're just waiting until those sellers turn into have to sells because it's coming. With interest rates and their loans resetting and them having to refi out of them, that time is coming.
Yeah. And the other thing too that I'm seeing on the market, I mean, I talk a lot about millennials. I like to follow some of these big, large cohort. I learned with the boomer group, if you can predict what they're going to do next, then you can capitalize on that. And millennials right now are the biggest cohort in the population. They're bigger than the boomers. So I think, and we know what the path is. I mean, if you haven't read like Boom, Bust, and Echo from Harry Dent, he was talking all about the boomers, but the patterns are the same right now with the millennials. So they're in the family formation stage right now. They want to move out of their parental home. If they live in an apartment, they want to move out with their partners, their girlfriend, boyfriend, or whatever, and they want to have a house so they can raise kids and stuff like that, and have the dogs run in the backyard and all that kind of stuff. And I see a decrease in demand for tenants for the multifamily.
I don't disagree with you. In fact, and I think the pandemic showed us a lot of that. And I think that's what drove a lot of the single family home price points through the roof too, is because people realized, okay, if the government's going to overstep and lock us down, we can't even leave our apartment. We got nothing to do. We want to move out of the city centers or out of these dense locations more to the suburbs where they can get a single family home for less a month than what they're paying in rent. They can have the land, they can go outside, they can enjoy time with their dogs, they can enjoy time with their kids in the backyard, whatever it is. And so that way they're not so controlled and have nothing to do. And so that's why, one of the reasons why I think you saw a mass exodus from city centers, especially during 2020 and 2021 during the pandemic, and what drove these home prices really, I mean, through the roof. I mean, you saw, single family homes in a good area, that had even a half-acre lot or a quarter-acre lot. I mean, there was 12, 15 offers on it within 24 hours of it hitting the market, and it was just driving these prices through the roof.
I know in Memphis, like we have apartment buildings there, and then we would have, like, for an apartment showing, we'd have 1 or 2 people, and we put a single family rental on the market. and we would have like 40, 50 people actually want to like see the property, and and then we would have like 10 or 20 applicants.
Yeah, I 100% agree.
Yeah.
And again, that goes to them wanting to, looking to build a family, looking to have a little bit more space.
Yeah.
And again, I think it's going to drive down that demand for rental, for apartments, for rent, apartment rentals. I still see rental demand increasing, but I think a lot of that is moving over into the single family home space.
Yeah, I think there's going to be a little bit of a shift because you still have some people like the boom, the millennials is kind of like, this was an age range, obviously. Right. So you have people that, they're still at their first step, which is, to get out of the parental home into an apartment. Right. But then you also have on the other end of the spectrum, people that are having kids right now, or they have right now, they married and all that kind of stuff. Yeah. So it's a spectrum. And then, so I think there's still going to be some increase in some rent, but I think in general, the trend is going to be much more towards the single family rentals. And this is where I'm kind of heavy on that for sure.
Yeah, and it's the same thing with us. I mean, our focus is on those single family rentals, specifically for the affordable housing. I mean, we're looking to build that portfolio to about 1,000 doors or so, over the next, 12 to 18 months. We're sitting at about just shy of 400 right now in that portfolio. And so we're buying heavy, we're raising money heavily for that portfolio. We're buying heavy for it. We got the process, dialed in. We can place a tenant pending, the HUD inspection timeline, but we can typically place a tenant and get cash flowing. We target about 30 days, from the day that we close. So it allows us to get up and running pretty quickly.
Yeah. And that's the thing too, like a lot of people want to have the multifamily because it's easier to get into, right? You have to be
economies of scale, right?
Yeah. You have one property manager, they manage the whole thing. Right. Now, if I have like a 40 unit or 50 unit apartment building, now I want to replace that with 40 or 50 single family home. It's a lot more challenging.
It is. It's a lot more challenging. There's a lot more work that goes into it, but it's also, a lot of it is just kind of like a rinse and repeat type of process, right? Once you kind of got it dialed in, pretty much everything you need to do. Now you're still going to have little things that are anomalies that pop up on every single little property that's, that you can't expect or account for. But for the most part, it's still kind of a rinse and repeat type of process. You're just doing a lot more often because they're individual properties that you're in that apartment with.
Yeah, and I think to me, like if you're starting in real estate investing, to me that's the ideal place to start because you can ramp up. You don't have to go and get like a 30 or 40 unit apartment building. You find the right market and you buy single family rentals.
Yeah, and where I'm at with apartments or multifamily is unless you can get yourself into a larger one, even starting off with a 10 unit or 12 unit, it doesn't really make sense to buy a duplex or a triplex or a quadplex because what you're going to cash flow on that, you can cash flow on a single family home the same amount, especially if you're going Section 8 or affordable housing route. And it's less work than a 3 unit or a 4 unit. But so if you're going to do it in multifamily, you got to go with a little bit larger property. The problem is if you don't have any experience in real estate, you're getting in way over your head from the start, and you can find yourself in a lot of trouble, specifically on the property management side, right? Because you don't know how to place tenants, you don't know how to manage tenants, you don't know how to manage turnover, you don't know how to manage expenses, and so there's a lot of factors that go into play that if you don't have any experience, most of the time you're going to find yourself learning the hard way.
So how do you select your markets for your affordable housing?
So we have a really tight buy box. So for us, we look at what our buy box is. So our buy box is between $85,000 to $105,000 purchase price on a single family home. We only buy single family homes for that portfolio. They either need to be in really good condition and move-in ready, or just renovated. We prefer ones that are just renovated.
Okay.
And then we have to be able to fair market rents from the housing authority for a 3-bedroom need to be about $1,300 to $1,350 minimum for us to look into that market. Okay. So combining those two, we're able to kind of pinpoint good markets for us that we want to buy in. And so We're really heavy in like Cleveland because Cleveland's a really good market for that. We have a great relationship with a rehabber there actually who buys, between 10 and 20 properties every single month for us, renovates them and provides them turnkey to us.
Yeah.
Detroit's another market.
That's weird. I mean, it's not us.
Well, here's the thing. We'll have this conversation. Where are you guys based out of?
Well, I'm in Fort Lauderdale, but I mean, we do have
Oh, okay.
Cleveland, St. Louis, Detroit. Yeah.
Well, we should talk about Cleveland for sure. Detroit's another market for us as well.
Yeah.
Memphis is actually a new market for us that we're moving into as well.
Okay.
And we actually have a satellite office in off of Las Olas in downtown.
Oh, okay. That's where I am. So yeah.
Okay, yeah. So that's ironic, but yeah, we should definitely talk because we're looking to build more of those types of relationships so that we can have steady units every single month for us that we can acquire once they're done being renovated and just immediately place a tenant, get the inspection scheduled, and be cash flowing.
Oh, excellent. So, any other kind of criteria in terms of the market, like the macroeconomics? Are you looking for anything like, or you can be in any market? I know for me, like I'm looking for landlord-friendly states. I'm looking for kind of like a sustainable growth, low unemployment, that kind of stuff.
Yeah, so we definitely like to focus on landlord-friendly states for sure. I mean, there's definitely some states we absolutely won't entertain. New York is definitely one of them. New Jersey's another. California, obviously.
No?
Well, no, we're good. Don't even mention that state to me. But yeah, so landlord-friendly states. Obviously, with that demographic or that asset class, you're going to be in areas that definitely have a little bit lower income demographic. But even then, we don't mind that so much. We do still look at crime because, like take Detroit and Cleveland, for example. If you go on one side of the town, the crime is absolutely horrible. But if you just go a little bit west, you're good. So we do focus a lot on crime statistics in the areas that we look to move into.
Yeah, that's right. A lot of people that I talk to, they're just like, oh yeah, there's a high crime in Detroit and stuff like that, or a high crime in Memphis or Cleveland and stuff like that.
High crime everywhere.
Yeah, at the city level, if you compare to your little town, yeah, maybe the crime is a little bit higher, but the crime, you have to kind of look at it at the neighborhood level. You can't look at it at the city level.
Yeah, they're looking at it at the macro level, right? And you have to get down to the micro level when you're looking at that stuff. Because I mean, even in Fort Lauderdale, right? Let's take Fort Lauderdale, for example. You go west a little bit, west of 95 in the certain areas, especially like up in the Pompano area. I mean, you find yourself in a really high crime area. But if you just go east just a little bit, there's no issues whatsoever. So, I mean, it's the same thing. It's a micro level that you have to look at everything. And again, people be like, oh, Detroit has high crime, Cleveland has high crime. That may be the case, but that's also where we can purchase these properties, place a tenant that we know we're going to get paid on every single month and cash flow what we can cash flow. You can't do that in Fort Lauderdale. You can't do that in Tampa. You can't do that in Miami. So you have to look at those markets that allow you to meet your criteria.
Detroit is a great market for that, for that reason, because a lot of people are shying away from that because, this is high crime, or it's it's too reliant on the auto industry and blah blah blah, and then it's going to crash or whatever, the economy is bad, blah blah blah. So, but we go in there and we find the right neighborhood that are up and coming, that we like in Hazel Park, East Point, Grosse Pointe, and all that. And these are great markets.
They are, and
Detroit, so we buy that a lot.
And you look at those cities. Memphis is another one. They've had a huge resurgence since the 2008 crash. You know what I mean? And in that 2008 crash, it was a once in a lifetime type of thing. Right. You don't see those types, and it was led by the speculative debt, and speculation and subprime debt. That's not what we're seeing now. It's not what's going to happen. And I've been saying it for the last 12 months. We're going to have a soft landing. We're not going to see this massive decline in real estate values. And everyone wants to argue with me. And I'm like, you can argue with me all you want, but it's going to prove it. And we're seeing that already. Everyone now is starting to come back around and say, oh, we're going to have a soft landing. We're not going to have a massive horrible, recession like we had in 2008. I'm like, well, I've been saying the same thing for 12 to 18 months.
Yeah,
so you're
I
not,
just published another video on my YouTube channel about that. Like, will the real
yeah,
estate crash in 2023? And I still don't see that happening. I see an increase in real estate.
I do too.
Not every market. Obviously
Right,
you have some markets like Austin, like you're gonna Phoenix, where there
right,
was like so much speculation, so many investors,
right.
and now they're trying to dump, or they were trying like last year, they were just trying to dump whatever
Get
they
rid of. Yep.
a massive price reduction. I mean,
Yeah.
in Phoenix, I think there was like 60% of the houses were owned by investors.
By investors. Yep.
So,
Yeah.
and as
And
an
they,
investor, I mean, like I
right,
want out. I don't care if I lose $10,000. I want out. If
right,
you live in the house, you say, "Well, I'm going to wait."
right, exactly.
House out.
Yeah, and so to that a little bit more. Again, it's talking about everyone looks at it as on a macro level, right? But you
Yeah.
really, I mean, real estate's location based, right? It's so what happens here is completely different than what's going to happen 50 miles from here, right? Or even 25 miles
Yeah.
from here.
It's really
And
market driven. I mean,
it is
I see a decline in some of the high price market. People can work from home now. So
right,
why am I living in downtown San Francisco
right,
with three other roommates? I can have my house in Cleveland or
right,
Hazel Park near Detroit. Like, why am I
right.
doing this?
Right, and you saw again going back to the pandemic, you saw a lot of that happening. You
Yeah.
saw a lot of those people leaving those big overpriced cities, moving to other states. You saw it, from California, everyone was migrating to Phoenix or to Texas, right? You
Yeah.
saw it in the Northeast. You saw people even from my hometown, Pittsburgh, right, or New York, or New Jersey, or Ohio, migrating down to Florida,
Yeah.
right? They wanted to get out of those states that had too much oversight, high priced,
Yeah.
not friendly states, into states that are going to give them more bang for their buck. They're going to be able to get more property for what they're spending. They can get out of the unit that they're renting and actually buy something for less on a monthly basis.
Yeah.
Which again drove some of the price points up, obviously.
Yeah.
But going back to what we were originally talking about, I just don't see a big crash happening because again, the market was driven by supply and demand.
No.
It's supply and demand that led to this massive price increase. It wasn't speculation and subprime debt that brought in a ton of buyers.
And it was really only the demand that was shifting dramatically, right? The demand was like super high, drove the price high, and then the supply was kind of okay. And then the demand dropped, and then some markets, and then all of a sudden, there was like in Austin and Henderson, Nevada too, like the prices dropped because the demand dropped. And then that affected the supply a little bit. But yeah,
you still see a supply
I'm not seeing is an increase like 2008. What we had was a surge of supply and
of inventory. Yep.
I'm not seeing that.
Yeah.
And
you're not seeing that because here's the thing. If you look at the amount of equity people have, take out those investor-driven markets, right? We're not talking about Phoenix. We're not talking about Austin. We're not talking about Henderson or Vegas. But primarily as a whole, the market across the country, people's equity in their homes went sky high, right? So they had a large amount of equity. And so they're not having to fire sale their property or put it on the market. If they have to sell it, first of all, they can put it on the market, sell it, get out of it, put some money in their pocket, move on. But when that demand dropped due to interest rates, the inventory dropped too, because those same sellers are not wanting to put their house on the market, sell it when they have a 3.5% interest rate, and then have to go find something to replace that at a 6.5% interest rate.
That's right.
Paying the same amount of money they are now monthly for a much smaller house. They're just sticking it out. So that inventory isn't hitting the market. The foreclosures are not through the roof and hitting the market. Short sales surely aren't hitting the market because of the amount of equity. So you don't have this fire sale and dumping of inventory like you had in 2008.
And I think the last year, the Q3 and Q4 last year, we had like an interest rate shock, and people say, "Oh my God, the interest rate is up to 6% or 5%."
It's incredible.
And it's just like I'm looking back, I have a little bit of experience, and then it's just, that's nothing. I mean,
that's normal.
9%, 8%. I mean, that's all good. I mean, the first house I bought, like my home, like we were like at 18% interest,
Right.
and
Well,
I
and
thought it was fine at that.
I agree. But it's that short-term memory syndrome people
Yeah,
have. They saw the 3% interest rates that you could get for a couple months
yeah.
during 21 and
Yeah.
end of 20, and they're like, well, this is how rates should be all the time. Meanwhile, the average rate, if you look over the last 30 years, the actual average rate is between 5.5% to 6%.
Well, yeah, I think the last like I think the 30 or 40-year average is 7.2% or something,
Yeah,
7.15%. So that's
right,
you know, and we're below that right now.
right,
So
exactly.
that's fine. And I think that's what I'm going to see. I think what's going to happen this year is that I don't hear that complaint as much anymore
I
about, oh, the
agree.
interest rate are high. I'm not hearing that anymore.
Right.
So people, I think it's kind of getting normalized already. And I think that's what happened last year is that there was that shock. And then there
Yep.
was, so now we're kind of done the adjustment period. And
Right.
now the people, the investors and the buyers are kind of like, okay, yeah, that's fine. I mean, we just, is it going to go down? Is it going to go up? Now I think it's going to kind of go sideways,
I agree.
down, up and down.
Yeah. Just like you had a shock when the rates were really low and this spike in new mortgage applications and new buyers,
Yeah.
when rates did rise, you had that shock on the downside as
Yeah.
well.
Yeah.
But it's just overreaction,
Yeah.
and I agree with you. Now I think we're starting to see it kind of level out. I think we're going to go sideways for a little while. I do ultimately see, after that period of sideways, I do ultimately see rates starting to drop.
Yeah.
In the near future, I wouldn't say within the next 3 to 6 months, but I think definitely next 8 to 12 months, you're going to start seeing the Fed cutting. I think you're going to in the 10-year Treasury dropping, which is then going to spill over into the interest rates dropping.
Yeah, but the interesting thing is that, yeah, the Fed is going to drop, but right now we're seeing a disconnect between the Fed rate and the mortgage, right?
I agree. Yep.
In November, the Fed increased their rate and the mortgage went up.
Down.
And
Yeah, exactly.
a couple of weeks ago, same thing. It's just like, so there's a little bit of a disconnect. It's not and people are looking at the headline, oh yeah, the Fed increased their rate and thinking that, oh, mortgage rate also went up. No,
well, that's
down.
Right, and that leads to a great point, is that most people actually think mortgage interest rates are tied to the Fed funds rate, and it's not.
That's right.
And again, it's education. It's tied to that 10-year Treasury, not the actual Fed funds rate. And so, I think people overreact to an interest rate hike, thinking that their mortgage is going to go through the roof and sky high, and it's just there's not that connection.
Yeah, the Fed rate is much more tied to like the consumer rate. So like
credit cards,
or consumer, if you want to buy a car,
personal loan, car loan,
exactly.
Yeah, exactly.
Then that's going to affect that. There's a much closer direct relationship there, but not so much on the mortgage. So you have to look at a website kind of like bankrate.
Bankrate, yep.
And then kind of look at, is it .com or .org?
Yeah, it's Bankrate. No, it's bankrate.com. Yeah.
.com, yeah. So, and then you can really see what's happening and look at the trends on, on the mortgage rate.
Absolutely.
Yeah. So this is all good. So I think that the mindset is kind of like been reset. The expectation, I think, is a little bit different about this year.
Yep.
We also have like low unemployment. I mean, you can't have more unemployment than that.
Right.
So even if the unemployment goes up, that's fine. We haven't seen.
And I think we're expecting it to go up a little bit, but again, I think we're going to have a much softer landing than anyone has been, than most people have been saying.
Yeah.
And like I said, I've been saying it for a while, just because being. And I think you can probably, you would agree, being hands-on a daily basis, especially in the real estate industry, it gives you a much better pulse on what the economy is doing as a whole, because we're dealing with people, right? We're dealing with tenants, we're dealing with mortgage rates, we're dealing with lenders, we're dealing with sellers. So I think we have a much better pulse on what's actually happening out there versus what the news stations are telling you.
Yeah. Yeah, absolutely. So I agree with that. And I speak with a lot of investors, and I kind of know what their concerns are.
Yeah.
And
I've seen a lot of investors, especially, over the last 12 months, really pull back because they were worried about interest rates.
That's right.
And I'm like, we're going to double down. Like that's our opportunity to get ahead of everyone else.
Yeah.
Okay, so we're paying 1% higher or 1.5% higher than we would before anyways. But as you know, you make money when you buy the real estate, not when you sell it. And so, we just make sure we buy it right to offset that little bit of difference. But when it comes to a single family and Section 8 and affordable housing, I mean, you can cash flow so good that extra percent and a half isn't going to make a difference.
And cash flows compared to a multifamily or it's like
they
don't even cash flow.
Right, exactly. I mean, we're lucky on some of our multifamily if we cash flow per door, after all expenses, debt, everything like that. If we cash flow $200 a month, we're like ecstatic, right?
Yeah.
But on our single family and our affordable housing, I mean, we're cash flowing net $700 per door.
Wow.
And so you can't compare the two.
Yeah. No,
so that percent interest rate hike doesn't make a difference.
Yeah. No, absolutely. So I think that's a great comment. Anything else that you're seeing on the market or stuff like that? I mean, I think that from the investor's perspective, because the interest rate is a little bit higher, the cash flow has been squeezed a little bit. We were getting the better cash flow before, but I think you have to have, as an investor, you have to have a longer term vision. And the cash flow increases over time.
Again, exactly.
Is the same, and then the other expenses are kind of like, going up at the same time. But your rent is
well, exactly. Your rent's increasing year over year as well, so your cash flow is going to continue to increase. And again, I think that's people getting bogged down in the weeds a little bit more. And too focused on something that really, in the grand scheme of things, isn't going to matter. If you're fixing and flipping, you're going to be much more interest rate sensitive, obviously, because and market sensitive and economy sensitive, because you have to do it in such a short timeline so that you don't fall victim to a massive economic shift or interest rate hike. But for the longer, I mean, real estate's a long-term game. Let's be honest. And so for a long-term investor, okay, so you're paying a little bit higher interest rate, but long term, it's gonna work itself out. And so the other thing too is I tell people, shop your lenders. We're constantly shopping our lenders. We were closing properties in the 9% range, 10% range. We found a new lender. We're closing at 7.10, 7.25 now on private capital, private investment capital. So that's a percent higher than what you can get on a 30-year fixed residential for your primary residence. So you always got to be looking at what's out there in the marketplace. Don't get so stuck with one lender and so focused on something that in the grand scheme of things is going to work itself out.
Because a lot of the lenders, I mean, they're in the business, right? So they have, every lender is a little bit different. They have different capital sources. They have different requirements from that perspective, and then they want to, invest it. And then the other option, if they don't invest it in you, they're going to put it like, they're not going to get the money from their source, their equity partners, or they're going to have to put it, if you're looking at a bank, they're going to put it in a 10-year bond or something like that. So that's kind of like what's going on. I mean, they have to do something with the money, or they're not getting the returns that they're looking for. And every lender is in different situations. So you're gonna have some lenders that are gonna charge. I mean, we have some that they're charging like 3 points and 7.5%, and then we have other lenders that are charging like 1 point and 10%. Not 10%, but 7%. So it's just kind of like you see the difference in. So shop the rate. Talk to multiple lenders and get the best rates that you can get.
Absolutely.
All right. So Matt, we're about to wrap up here. If people want to reach out to you, they want to reach out to SIMM Capital, get more information. So how can they reach out to you?
So you can find me online, social media. If you go to Instagram, realmattsimmons.com. Just remember, my first name's only spelled with 1 T. And you can check out SIMM Capital, our website. Just go to simmcapital.com. If you're having a little bit of issues with that, which we just noticed, hopping on here, just to make sure you type in www. ahead of that. But I will have our tech team look into what's going on there. But yeah, just check us out, simmcapital.com. You can check out our offerings, learn a little bit more about us, sign up for our investor portal, see what we have going on right now, and get you all the information you need.
Great. Excellent. Thank you, Matt.
Appreciate it, Eric. Thank you so much.
Talk to you later.
Thank you for listening to Break Away from the Rat Race with your host, Eric Martel. If you want to share your story and experience with our listeners, please message us on Facebook at Break Away from the Rat Race. Also, please subscribe to our YouTube channel and our podcast on iTunes.